Hello everyone, this is Finance with Shizuka. Today we will be doing a question from financial management for investment decision. And the question is Melplash. This is a question from March June 2022. And in this question, first let's see what our question says. This says that for the proposed investment in new motorcycle, calculate the following: net present value, internal rate of return, payback period, and return on capital employed. So first let's look at the question over here. Now our question says that Melplash Co. manufactures motorcycles and it is considering an investment in new high performance model, and the target for high performance motorcycle is very competitive, and Melplash directors want to recover the costs of this investment more quickly, so before it is made obsolete by more advanced tool at the end of year 4. End of year 4 means that this end of year 4, this shows that this is the life of product, this is the life of, you could say, our motorcycle, right? And now it says the director also wished to show the shareholders that the investment will be profitable, and the directors have therefore set target payback period of 2 years and target return on capital employed of 20%. So this is their targets, and the directors have also asked the finance director to provide the net present value and internal rate of return calculations for the investment. So they will plan to consider the results of these calculations if the investment fulfills the target for payback and return on capital employed. Now, so Melplash has prepared the following forecast production and sales of the new model. Forecast of production and sales. So this is the sales. They think that they will be able to sell this much units, and this is, our rest in down below says ignore taxation, so we're gonna ignore our taxation. Now let's begin with the question. So for this question, we do want to have our, net present value. So this is part A, requirement A, and part 1 for requirement A. That is the net present value. Okay, now for that we need to establish something. Let me make my screen smaller so it's easier for you to see, and zoom in on the screen. Okay, so for the net present value, you can say over here that first, everyone has a different criteria how they pursue the question. For me, it's like I always write the year first, write year 1, and then year 2, year 3, and year 4, right? Now, once we're done with the year, then we put on our number of units. That is this. Our number of units would be number of units. Now, in the year 0, we have no units. Now we have 25,000 over here. Then we have 45,000 over here. We have 40,000 units over here. We have 20,000 units over here. Once we're done with the number of units, now let's see what other thing that we want. If you see, you want the selling price of our motorcycle. So selling price would be, it says here, if you see this selling price here, 20,000 for motorcycle, and expected selling price inflation is 6% per year. So first year selling price would be 20,000. So it would be 20,000, and then it would be 20,000 multiplied by, you could say, our inflation, that is year-on-year inflation. This is like in year 2, the price is 21,200, and on top of that, the inflation for year 3 would be 6% more. So like this, you'll establish all your answers for the 4 years completely. 1.06. We have our selling price including inflation. Now revenue. We know that revenue is always number of units multiplied by the selling price. Done. As for the second, number of units multiplied by selling price. We do the same for year 3, number of units multiplied by selling price, and the same for year 4, number of units multiplied by the selling price. Once our revenue is done, what else do we need? Now we need to subtract for the cost, but we need to find out the contribution. So for contribution, we need variable cost. So first we will be subtracting our variable cost. So our variable cost is, let's again see our information given to us. Let me change the color for you guys. So variable cost, 1 year, year 1 price terms is 4,000. Please correct this. This is 14. Sorry about that. This is 14,000. 14,000, and expected variable cost inflation is 6% per year. So we will be including expected variable cost as well. So is equal to, this would be 14,000, right? And now what we would be seeing is 14,000 multiplied by 1.06. Enter. Is equals to, we'll take this amount multiplied by 1.06. Enter. Is equals to this amount multiplied by 1.06. Enter. Now we have variable cost including the inflation. Now what happens is, this is for a single unit, right? We need total variable cost to subtract from the revenue to get our contribution. So what we're going to do is that we're going to take the variable cost per unit multiplied by the total number of units. That gives us that. And if you want to go, one more far, what you could do is you can include a minus sign if you want, right? Is equal to this multiplied by this. Now is equals to variable cost per unit for year 3 multiplied by number of units. Then again, variable cost per unit multiplied by variable cost total number of units for year 4. Now we have our total variable cost. Now we can easily calculate our contribution. Contribution would be revenue minus variable cost. Just for for your sake, I'm writing that here. So what's our revenue? This is already in minus, so you don't need to again. You'll just put in the plus sign. Just right. Put in the plus sign. Then again, revenue minus total variable cost. Again, revenue minus total variable cost. Sorry, we're gonna plus this one. My bad, my bad. So now we have all our answers. Right, we have our contribution light up over here. Now comes fixed cost. So for fixed cost, you can see they have given us incremental fixed cost and with inflation, right? So incremental fixed cost is the fixed cost that is arising because you are taking up the project. This is not a general fixed cost. Okay, so you should know that this is only arising because you are taking up the project. This is not a very general fixed cost. So if you did not take up this project, then we would not have to bear this fixed cost. Then this is 120 million, 123, 123, when I always count my millions like that, is equals to, we're going to go ahead and select this one, multiply by 1.1 because inflation. And if you want, again, you can put a minus sign, right? Minus, not here, oh, let's put on the minus sign over here. Let's put in our minus sign over here. So this would automatically give us that. This multiplied by 1.1 is equals to this multiplied by 1.1. Now, once we're done with the fixed cost, our next step is to calculate the cash flows before tax. Cash flows before tax. There's no tax, but we do write it. You should write it because it's a good habit. Now, our cash flows before tax would be is equal to our contribution plus right is equals to contribution minus fixed cost. Again, contribution minus plus minus fixed cost is equal to contribution plus fixed cost. So this gives us cash flows before the tax. Wait up. Yes, this would give us negative. So that happens that we will be going in loss in year 4 eventually. Now, what was our initial investment? Let's line here. Initial investment. Initial investment would be 220 million, right? Now, this would be um, the residual value. The residual value is our selling price. Is equals to 30, 1, 2, 3, 1, 2, 3, right? Initial investment is our outflow. So what we're going to do, like that. Okay, so our net cash flow is equals to, our net cash flow would be before tax plus investment. That is equals to, and the last log would be is equals to cash flows that we were going in negative. Now we would be going in positive soon. Okay, net cash flow because we sold it. We sold our investment. Now NPV, right? You have to see this very carefully. For the NPV, we would be calculating our total, right? For NPV, we have our 40%. Okay. Give me 1 second. For NPV, we would be using is equals to NPV, right? We will be using sum. Here we will be seeing this one, 14%, 14%. Then we're going to be having a comma, then we're going to be having this, then this, right? Okay, and we're going to be having a positive. The last year would not be included. So what we're going to do is, just give me 1 second. I have to make sure that the formula is correct. Okay, so yes, the formula is correct. Now we're going to add our initial investment. Press enter. We got this. Just don't look at the zero. So this we have our answer is 16 million, 7 something something. So this is our NPV answer.